Hello, I'm Christopher Tate and welcome to 2019. Now, before 2018 recedes into the rearview mirror and becomes little more than a series of horrible recollections, I thought I would take a look back at the year that was, and I want to do so in a more nuanced and hopefully more productive manner than you tend to get from the mainstream media and all the screeching commentary that seems to have accompanied the previous year. Undoubtedly, you will be waking up to headlines such as this: the ASX closes out worst year since 2011. Well, my response to that is, in part, not very subtle, and it revolves around the expression, so what? Since this conveys no information to me, it doesn't tell me anything. And admittedly, when we look at the scoreboard for major indices for the past year, most of them have finished in the red. And in compiling this list, I went through about 6 dozen indices around the world. And of that grouping, only 5 finished positive for the year. Now you can see that we are neither the best nor the worst. We're somewhere sort of in the middle. The honour of being the worst goes to Chinese markets. The honour of being the best goes to Indian markets. And once again, we are trailing the Kiwis, as always. But these league tables don't convey much to me because they operate on a very, very simple assumption. And the assumption is this: that you buy the index on the first day of the trading year and then sell it on the last day. Nobody in their right mind, outside of a fund manager, would contemplate that as a strategy. And so this sort of very broad performance metric tells me very, very little about the trajectory of the movement. It is quite possible for a market to have gone up 100%, then down 50%, and finished at exactly the same price. But knowing that it finished flat does not tell me about the range of movements that occurred. And by and large, it tells me a little bit, but not much, about the underlying health or ecology of the stocks that make up the market. We have to start to take a more nuanced and slightly calmer view of what has occurred to get a sense of what is actually real. If we look at the US markets, we can see that they began the year on the tail end of the bull market that had been running now for almost the better part of a decade. Market then collapses into congestion, and you then get a single tradable move that begins in the second half of the year. This market then collapses again and falls out of bed. You'll note when I talk about indices, I talk about only being long. And I talk about only being long the actual indice for a simple reason. I find that shorting indices is a drag on performance because an index has an upward bias. Every index in the world is rife with survivor bias. This is particularly true in the Australian market, where the ASX 200 has in probably the past decade turned over almost every stock within the market. Rubbish stocks are thrown out, new ones are brought in. So the index is not telling you the complete picture. As such, I tend to avoid shorting the index itself. This does not mean that the environment is not ripe for strategies such as options writing. And you can see here in the Dow, there were multiple opportunities for options writing. And this can be defined by the dotted green line that is on the screen. This is simply a continuously plotted 380-hour stop. And you can download this, or you can download the code for it in Metastock from the internet. You simply Google 80-hour trailing stop, and this will be one of the returns you will get. There is nothing magic about this tool. It is simply a trend-following tool, that's all. And because I view the world in a very rectilinear way, I'm very blunt, this conveys more information to me than a moving average. But if I were to run a moving average over it, I would get exactly the same signals. So this comes back to the notion of you set your trading system and the way you see the world for the way you see the world, not the way I see the world. And here, when we take a longer view, you can actually see the tail end of that bull market. And I'm going to come back to this for an important reason. And the issue with markets is you can only get what the market will give you. You can't manufacture returns when they're not there. For example, in the last quarter of this year, if you had been a long US equities trader, your performance would have been diminished. That's to be expected. To use the very, very old expression, you can't get blood out of a stone. If the stocks are not moving in the manner you want them to move, then there's nothing you can do about it. No amount of positive thinking, visualization, chanting, meditating, or whatever will make your stocks go up. That's simply the way of the world. So when you have an issue like this, when you've had a market that's come out of a very, very, very strong uptrend, it is incumbent upon you to actually trade that uptrend for all it's worth, because eventually they come to an end. And I think this is the point that is catching people. Markets eventually stop heading in the direction you want them to go, and they will go in a different direction. That is just the way they function. And if we search for some degree of context as to what this year's results mean, what I've done here is I've plotted the yearly returns for the S&P 500 dating back to 1926. So we're closing in on almost 100 years worth of data. You can see there's a lot of red scattered in there. You can see there's a lot of blue. But there's an interesting little take on this. The purple line is the long-term average return of the S&P 500. Whilst averages are a blunt measure, they count. Not every year can be an exceptional year, and it is simply childish to expect that every year will be an exceptional year. Unfortunately, very few stock traders view trading as a business. If you run a business, there are very good days to be in business, there are ordinary days to be in business, and there are probably very bad days to be in business. That is a difficult concept for the majority of stock traders to understand. They all seem to accept that the market must return 60% per annum to them. Well, the market doesn't have to do anything, and the market is actually incapable of doing that. It's somewhat of a childish stance to take, and it really does lack any form of understanding or nuance as to how markets work. And this is why I constantly harp on about people being students of the market. I can guarantee you that for the vast majority of people who are viewing this, this will be the first time they've seen a screen like this. History is an anathema to most people. They struggle to look back further than yesterday. But once you understand how the cycle of business works, and the cycle of markets therefore works, we can start to make adjustments. We can change the way we think. We can alter our trading strategy so that we're not caught by this very dogmatic expectation. The issue here is quite simple. When the trends are there, as they had been in the US markets for the past decade, you trade them for all they're worth. You must be as aggressive as your account and, more importantly, your emotional tolerance will allow you to be. Because there will come times when you're just sitting there waiting and you have to look for something else. You have to look for a different market, a different idea, a different approach. But if the waves are not there, the waves are not there. You can't force them. Nothing you can do can force them. This leads me to a notion on how people try and cope with these poor quarters. The data here looks at the quarterly performance in the S&P 500, their 1 year return, 3 year return and 5 year return post that poor quarter. What people do with these sorts of metrics is they try and take comfort from them, and they say, well, a down quarter is obviously followed by an up year. And upon initially looking at this data, most people stop at the first line and they go, well, in June 1932, the market fell almost 38% in that quarter, but next year gained 162%. Again, this lacks context. And the context comes from understanding where the data comes from. If we look at these points in history, these are actually the tail end of bear markets. They're blow-off markets. And so what's actually happened is we've simply run out of bears. And therefore the bulls gradually assert their ascendancy. But even that doesn't convey some of the subtlety within the data. Because when we start to look, we can actually see that there are an extensive number of periods where the quarterly performance was not in any way, shape or form wiped out by next year's performance. There is a harsh lesson in financial mathematics, and it says that a 10% gain cannot be recouped by a 10% profit on the remaining capital you have. It takes 11.1. So you have a curve that you are chasing over and over again. And so when we begin to look at the data, we can actually see it's not as obvious or as crystal clear as we might have expected. There are still problems. And part of the problem at present is defining as to whether we are actually in a bear market or whether the corrosive influence of having Donald Trump in the White House is simply grinding people down. We'll only be able to tell that by looking back. Only hindsight will tell us that. We cannot make that judgment in advance. And this is one of the issues with trading, particularly when we look back over a year. We're looking back with the wonderful clarity of hindsight. And hindsight is the perfect investment tool. I can tell you precisely what the market was going to do last week. I can't tell you precisely what it is going to do next week. The problem people have in understanding this is the notion of recency bias. Recency bias simply says that yesterday was like today, therefore tomorrow will be like today as well. There is no depth of understanding that time is very deep and continuous. I'll use a current example we're experiencing here in Australia. Real estate in Australia has, since the GFC, been booming. It has been the standout asset class of all. That has now stopped, and what is catching people is that they can't understand that it has stopped. Because their assumption is, well, it wasn't like this yesterday, and I can only recall yesterday, so therefore it can't be like that today and it can't be like that tomorrow. They don't understand that when you look at markets of any sort, shape, size, tone, that you need to look back longer than your memory. And the unfortunate thing for markets is they attract people with very short-term memories. They also attract people with a very short-term focus to their money. So nobody, I won't say nobody, that's an overstatement. I would say the vast majority of people who are investing in real estate have not looked back more than 5 years. But the data we have for real estate goes back decades. And it shows that all booms end in busts. And that's a universal law. There are very, very few universal laws in trading or investing of any sort. But the one which is the most concrete is simply that. All booms end in busts, and all busts eventually end. They eventually transition into a new form of market. And just to make people feel bad, particularly those who were under the impression that Bitcoin was going to $1 million, This is the 1 year relative performance of a series of cryptos. And you can see, to use a technical term, they are all rooted. What caught people here was a simple misunderstanding of how markets work. And the simple notion that things change. And that we'd seen this before. And this is a discussion I've had numerous times with people who invested in cryptos. And they all use the same expression. This time it is different. I have lost count of the number of times I've heard somebody say that when the market is in this stage of mania. Because the one constancy is that people say, this time it's different, just as markets are coming to an end. That's a form of self-justification for themselves. That's a form of balm that they apply to their own psychology. And we've seen this before. If you go back and look at any of the great booms in history and you chart Bitcoin, you can overlay it over the top of the dot-com boom. You can overlay it over the top of the Tokyo real estate boom. You can even go back to the Dutch tulip boom and the South Sea bubble. So you can go back centuries and see the same thing. This occurs because people don't change. Individuals might change, although that's a matter of some debate I might have. But markets don't change. And the behaviour of people in markets will never change. And so we will undergo this endless repetition of boom-bust. But that's a positive thing for the Australian market, simply because eventually our very moribund market will show some degree of life, some degree of energy that will get it going. When that is, I have no idea, nor does anyone else, more importantly. And this is an important safety hint. Any idiot who comes up to you with predictions about where the market is going to be is generally an idiot. I've lost count of the number of people who have approached me and said they can predict where markets are going. The unfortunate thing is the proof is in the pudding. They're all poor, most live at home with their mother still, which is not a bad achievement for a man who's 51, and they all drive their mother's 30-year-old Corolla. If I could predict where markets would be, I would probably buy New Zealand and concrete it. This raises the question of what to do. Well, the ASX market cap in total is about 1.2 trillion, give or take. Market cap for the US is about 10 times that. But you're still caught by the same trap that equity markets tend to, by and large, cluster together in their performance. And so we need to find another mechanism, another way of allocating our capital, finding what to do. Here I've done the same thing as I did for equities. I've simply plotted the major commodities 1 year performance. And you might say, well, hell, it looks kind of like the equities market. It doesn't really help me much. There's a trick. And the trick is to look at the wings of this distribution. That is, the points at either end. There is often commentary, and there's been commentary this year about how poor commodity markets have been. There needs to be a caveat applied to that. They're only poor if you are long only. You don't have to be long only in commodity markets. It's just as easy to go short as it is to go long. They do not have the same inherent bias that equity markets do. Granted, they probably display a degree of seasonality that you need to be aware of, but you can go short. So if we look at the wings, we see cocoa had a sub 30% gain, gasoline, crude, a sub minus 30% fall. So you have this capacity to take advantage of these moves as they occur. And this is cocoa. And you can actually see that cocoa began the year with a very, very strong trend. It then fell away, congested, fell away again, congested again, fell away again. And it's now in a broad band of congestion that's been in for the last quarter of this year. But the important thing is it began the year with a very, very strong trend. It gave you an opportunity. Markets present opportunities to you, and it is up to you how you view this opportunity. I posted an article on the blog yesterday, which is a very good one by someone else, and it relates to the notion of how you view the markets. Do you view them as kind or hostile? And it comes back to a quote that haunts me from Ed Sakota, that people get what they want out of the market. The market will merely manifest what you want. Now, I'm not talking in terms of idiot things like The Secret, but it is the capacity to spot and take advantage of these opportunities as they occur. If you view the market as hostile, you will be very, very fearful about these things as they unfold, as they occur. So you won't be able to spot, for example, this trend in cocoa. Likewise, if we look at Brent crude, you can see it began the year following through from its existing bull trend. Prices then collapsed, it took off again. Prices congested, collapsed, took off again and moved to a new relative high. Prices then collapsed completely. So you've got the opportunity here to profit because you can go short. You don't have to go long. You can just as easily short crude as go long crude. It is whether you want to take advantage of that move as it occurs. Because my observation of traders over the years is that it is not, by and large, their entry system that dictates their profitability. Granted, if you're one of these idiots who looks up at the moon, feels the bumps on your grandmother's head, craps on about sunspots, your chance of being successful is pretty much zero. Now, it's pretty much zero simply because of your own psychology. You believe in magical thinking. And children tend to grow out of magical thinking about between 7, 9, 10. Some adults never do. Markets are fundamentally unpredictable, but that doesn't mean they're hostile to you. That just means they take a little while to reveal their secret, and it's then up to you what you do. The key point in all trading is trade management. There's simply no reason why, when this market collapsed, as it did in October, November, that using any trend following tool in the world, it doesn't matter which one, nor does it matter what number, you would have seen that collapse, and it would have been incumbent upon you to take advantage of that collapse. This raises the question as to how well did people do. I post my equity curve for my leverage system on the blog regularly. So you can go and look that up if you want. But I thought it would be more interesting to look at the results of someone who is a new trader. And this is someone from our mentor program. And I'll walk through these results because they're actually very instructive. You can see total number of trades taken, 103. For this system, and I know what this system is, that's probably a bit too many. 21 winners, 58 break even. Profit of this... Here's a point. Win-to-loss ratios, by and large, don't count. And they don't count for the simple reason that we're not interested in being right, we're interested in being profitable. The profit of the system was 81.5 R. That needs to be fleshed out a little bit. R refers to a multiple of risk you use. So in this instance, if this person was using $1,000 risk for their system to initiate a position, to position size and money management off, the profit for their system for this year is 81.5 R. So let's assume they were risking $1,000. Their profit for this year is $81,500. And you can see, even though it was a dodgy year for a lot of things, there was still a 16.5 R move in the Hang Seng. There was the tail end of the Dow move. Base metals moved so that both zinc and copper were profitable, and as was crude. And here's the important point. The peak drawdown was only 7R. So the risk in this system was very, very tightly controlled. It's a very, very, very well managed system. And it gives you an indication that even though you might think, and even though everybody might be screaming at you how poor markets are doing, they're only doing as poorly as your perception allows, and they only do as poorly as the limitations of your knowledge and your understanding of history and other markets. So that raises the question as to, what did we learn from this year? Did we learn anything? Well, my answer is no. We've not learnt anything that we've not already known since we've had traded markets, and that's really quite simple. Markets go up, markets go down. Follow the money. And by that I mean, follow where the trends are. Don't keep pushing at markets that aren't working. If a given market is not working, look somewhere else. And there is a plethora of tools on the internet that will tell you what markets are performing. They're not hidden. There's no great secret cabal run by George Soros, as some lunatics believe, hiding from you which markets are moving. If you don't already understand or know, go to a site like finviz.com and have a look at their performance charts. They will tell you over any time frame you want to know what markets are performing. The hard part is it's then up to you to get off your arse and do something about it. And the final point for this year, and this is always the overarching point, and that is to simply eliminate the noise. Unfortunately, in trading, there is now so much noise that it overwhelms people. People subscribe to Facebook pages, they get endless magazines, they're on endless forums. You will only be profitable when you start to think for yourself.